It's our week number 6 lecture video for Business 330. Today's date is Monday, November 28th, as we begin our week 6 with an assignment this week, assignment number 3, where you are to complete a capital budget spreadsheet analysis. And more on that in a little bit. Tonight, a full plate on our agenda. We're going to review the second half of week number 5 problem, the problem to determine cash flow, to practice determining cash flow, problem 9-14. Then we're going to do a new analysis in our review tonight, where we're going to determine the cost of capital and another project analysis. And then once that's over, we'll introduce assignment 3, which is due Sunday, December 4th. Okay, hope everybody had a great Thanksgiving weekend and ready to begin our work for capital budget analysis for this week number 6. If you remember, in week number 5, we began our study of capital budgeting analysis with problems 1 through 8 in chapter 8, where we practice determining the 4 methods of return analysis: net present value, internal rate of return, profitability index, and payback. The 4 ways that you can determine whether your investment in a project generating enough cash flow to make that project profitable, positive return. And then we looked at and began to look at chapter 9 problem 9-14, where we actually had to go and calculate the net cash flow. Remember, in chapter 8, I gave you the cash flow, $80 a year, $100 a year. Well, now in chapter 9, we learn how to calculate those cash flows. Cash flow is meaning the amount of revenue and expenses and profits you generate from that investment, taking out taxes, working capital, depreciation, salvage value, and determining the net cash flow. How to determine that amount is what chapter 9 is all about. So let's take a look at this problem. So here's the problem at the end of chapter 9, problem 9-14 at the bottom of page 296 and into page 297. In this problem, they give you all the variables of the project, and your job is to determine what the net project cash flow is, knowing all these variables. And that's what you're going to have to do, and what we're going to do in a practice problem this evening, and what you're going to have to do in assignment number 3 is to determine the net cash flow, then calculate the net present value, the internal rate of return, profitability index, and payback, the steps necessary to complete a capital budget return analysis. So let's go ahead and put together this project based on the variables given to us. Okay, they tell us that the revenues are going to be this is a 4-year project, which means that's the depreciable value of the asset. It's a 4-year project with revenues of $40,000, $30,000, $20,000, and $10,000 a year. The expenses are a little bit easier to calculate in this example, 40% of revenues. The working capital required in each year is expected to be 20% of revenues, and we'll define that in this analysis. And the project is estimated has an investment of $45,000 in plant and equipment. What we're going to have to do is determine also the depreciation, straight line depreciation over 4 years, with a firm's tax rate of 40% and a cost of capital of 12%. What is this project's NPV and internal rate of return? We'll also go ahead and do profitability index and payback just for the practice. So now the big hassle is, how do we put all this information into a nice, neat analysis that tells us that this investment of $45,000 is going to pay off? So let's put that together. First of all, let's go back to our spreadsheet. There it is right there. And we are just told that the investment in our project is going to be $45,000. There it is right there. Notice in this spreadsheet, I have some preset calculations, which will make it a little bit easier to see how this all works. And then we're going to have revenues. Remember, they told us revenues of $40,000, $30,000, $20,000, and $10,000 a year. Those are our revenues. And remember, they told us, and you can refer back to this when you're doing your review, that expenses are going to be 40%. Let me hang on here. Are going to be 40% of revenue. So equals revenue times minus 0.4, that's 40%, and there's our expenses. So we'll just copy that all the way across, and that's 40% of revenues. All right, now on the other hand, it's a $45,000 investment, straight line with no salvage value. So how much depreciation is that over 4 years? $11,250. That's how much we're going to depreciate. Remember, depreciation is a way to reduce taxes by a way of expensing an asset without even writing a check. And that's the IRS lets us do that. So now we have depreciation as being $11,250 a year. So let's copy that all the way across. And now we've determined the net income for this project after each year. I took the revenues minus the expenses and depreciation to get earnings before taxes. I took 40% of those earnings as our taxes, and I'm left with a net income of $7,650. $4,050 in year 2, $450 in year 3, and also remember, we're losing money in year 4. Our expenses are higher than our revenues, so we're losing $3,150 in our final year. They also tell us in the problem that working capital is 20% of the next year's sales. Now, what does that mean? Well, working capital is a balance sheet item. It's for example, here's an example of working capital. I buy a car. Let's say I buy a car for $45,000. Just buying the car is not enough to meet the needs of the asset. What else has to happen? Registration, insurance, maintenance, all kinds of things. So there's additional expenses and additional upfront money to operate the vehicle once you buy it. And that's what working capital is. So in this problem, working capital is how much additional cash are going to be needed to keep that asset going until you start recouping and selling product off that investment. That's what working capital is, a very important line in capital budgeting analysis. And it's based on next year's sales. So example, they tell us in the problem that working capital is 20% of the next year's revenue. So if I take 20% of 40,000, that's $8,000. So I'm going to have to pay out an additional $8,000 in additional cash in the 0 year when the project begins to get that asset of that investment off the ground. Then during the course of the project, notice that revenues start reducing. So if I take 20% of $30,000 in year 2, that's $6,000. So now I need to add back $2,000 of working capital back into the project. Here's why. Notice working capital, remember, is a balance sheet item. So notice negative 8,000 plus 2,000. The balance now is $6,000, which happens to be 20% of 30,000. Same thing holds true in year 3. 20% of 20,000 is $4,000. I give back another 2,000. The next year, 20% of 10,000 is $2,000. I have to give back $2,000. Note the balance now accumulated in working capital is what? $2,000. Then in year 4, I have no year 5 income. All I do is take 20% of year 4 income. That's 2,000. Add that back in. And there's my working capital cash flow. Notice I'm spending cash in year 0, but then as my revenue drops, cash is coming back in. And notice this is the key in working capital for any capital budget analysis. If you take from year 0 to the end of the project, what does that total? 0. The net effect on the project over the course of its life is 0. Cash out, cash in, the net effect is 0. That means you've properly allocated working capital. The last thing we have to account for is adding back in depreciation into the cash flow. Because remember, depreciation is a non-cash expense, so I add that back. And now we have concluded and we have come up with our net project cash flows for year 0 through 4. And what does that mean? We're generating over the course of 4 years $62,000 of actual cash generated off this investment of $53,000. Well, when you think about that, that looks pretty good. We're recouping all our expenses or our costs. But remember, this money out into the future has a cost. And the cost of capital in this problem is given as 12%. So like we did, remember in the chapter 8 problem, we were given the cash flows, and then we had to discount those cash flows back. In this case, it was 11% cost of capital. Remember, we did that last week. Well, now in problem chapter 9, we've calculated the cash flows and given the cost of capital of 12%. Now we have to discount those cash flows back at 12%. Formula, function, NPV, just like we did last week. And our rate is 12% in this problem, the cost of capital. And the values are paint from year 1 through year 4, C14 to F14. So that $62,000 is discounted back to today's dollars at 12%. We get $48,622.29. Uh-oh, we got a problem in this project. The net present value is a negative. Our return is less than our investment. Not good. Let's see what the internal rate of return is. Remember, we did that back here in chapter 8, the internal rate of return. So formula, function, IRR. And all we do is paint the cash flows from year 0 to year 4, B14 to F14, and we get 7.5%, which makes sense. Our return is less than our cost of capital, 12%. Remember in chapter 8, our return was 21 and 23% on a cost of capital of 11%. We were making money. Now we are losing money, negative NPV by big time, and thus our internal rate return is less than our cost of capital. Not good. Remember, the profitability index is the relationship of the discounted cash flow to the investment of 53,000, and the ratio is under 1. Not good, 0.92. And the payback in years is, well, in the first year we have 53,000 investment. We take in the first year cash flow of 20,009. We got 32,100 left to recoup. In year 2, 32,001 plus the year 2 investment return, we still have 14,800 left. And we'll take that out into years 3 and 4. And as you can see, we don't pay back the investment into sometime during year 4. How much of year 4? Well, we take the percentage of what is left to be recouped at the end of year 3, $1,100, and we divide that by the year 4 return of 10.1, and we get 11%. 3.11 years to pay back. We go into the 4th year. Remember, we only have to pay back 1,100. We get 10,001 in the 4th year. So that means about 11% of the year is used to pay back the remaining $1,100, 3.11 years. So looking at this project and problem in chapter 9, after computing the cash flows and doing our investment return analysis, it looks like this, you can call this project a dog with fleas. Why? Oop, a dog with fleas. Why? It's losing money. Where in chapter 8, we had two projects, A and B, that generated positive returns. But in chapter 9, we actually computed the project cash flows and we end up having negative returns. Not a very good outlook for this investment of $53,000 in year 0. So as you can see, our job as financial managers is first of all to determine what we're investing in, what's going to be the depreciable life, and then calculate with the help of our marketing department, our production department, our accounting department, what do we project revenues to be, expenses, taxes, what's going to be our net income, what's going to be our working capital requirements, what's going to be adding back in depreciation as non-cash expenses, and determining our project cash flows. And once we determine that project cash flows using our cost of capital for this particular case or project, what is the return in dollars, percent, ratio, and years? This is what assignment number 3 is going to be. And this is a key component of determining investment return in finance. So I'm going to repost this to week 6. So you have these solutions to review. Let's save that. And now let's take a look at a new problem for our discussions for this week 6, taking this a step further. What are we going to be doing? We're going to be looking at how to determine our cost of capital. How does you come up with that? It's called a weighted average cost of capital. We're going to learn how to calculate that amount, and then we're going to put it into another variable problem to determine cash flows and investment returns. So let's take a look at that right now. Okay, here's our week 6 lecture video where we're going a step further. We're going to calculate the cost of capital, better known as the WACC. We're going to calculate how that is come up with. This is what chapter 9 and 10 and 12 are all about. And then we're going to take that information and do another cash flow analysis to determine NPV, IRR, profitability index, and payback. We're going to do it again. We're going to, again, using these variables, create this return and determine our cash flow and make our investment return analysis. Just like we did in chapter 8, chapter 9. Now we're going to do this. And this is very similar to the format that you're using in assignment 3. The best part of assignment 3, though, is I give you the cost of capital. You don't have to worry about calculating that. But down the road in the examination or final examination, you'll have a problem again similar to this, and you will have to calculate the WACC. So it's important for us to understand that. So again, capital budgeting is a process by which you determine how much you're going to invest in an asset, where you're going to get the money for that asset. That'll determine your cost of capital, as we'll see in a minute. What's the depreciable life of that asset, which determines the life of the project or the asset investment? What is going to be the net income generated off the investment? Then what is going to be the net cash flow, including depreciation, working capital, and disposal, salvage value? We didn't have that in the chapter 9 problem, but we will have that here. How much do we get for the asset after its disposable life? Then we determine the return analysis, what we've done and practiced already. And then the last phase, which you do not have to worry about in this class, is to do a risk analysis, a scenario and a sensitivity analysis, which are talked about in the textbook, but you are not required to know that in this class. That's more of a scenario, or an analysis for a master's in business administration finance class, which if any of you go further, you'll run into that in the corporate finance class. But we're only concerned with parts 1 through 5. So let's take a look at how to determine the weighted average cost of capital. And it's using fundamentals that we've already learned in our class. First of all, what is the relationship of the capital structure for this particular company we're looking at with this investment? And it just happens in this company The capital structure is 60% debt and 40% equity. Remember, the capital structure has to equal 100%. So 60 and 40 is the percent of the balance sheet in this particular company's problem. So what we're trying to determine here is what is it costing them right today to pay for this capital structure of 60% debt, 40% equity. So we get some information. The company's tax rate is 30%. The interest rate that they're paying on their debt that makes up this 60% is 9%. The current risk-free interest rate with a beta of 0 in the market is 3.1. The current market rate of return on the stock market with a beta of 1 is 10%. And then the firm's beta is 1.35. Now I had you look up beta in our midterm. Part of that is a beta is a statistical analysis. And if any of you have taken statistics, you might have learned it there. It's called correlation analysis. And it correlates the return of a particular company to the return in the market. Market average is 1.0. If any beta or any calculation is over 1, it means that particular company is a little bit riskier in getting the return you want in the market. And that means it's in this problem, it's 1.35. So you're never going to have to calculate that here. It'll always be given to you. But the reason why you need the beta is because it helps you determine the expected return of equity in this analysis. So let's take a look at this. First of all, what is our after-tax cost of debt? What is it costing us to get this 60% of capital? Well, first of all, our interest rate on our debt is 9%, but with our tax rate of 30%, we get a tax deduction for part of that interest. Remember, for corporations, they can deduct interest as an operation or tax deduction on their taxes. So the true cost of debt is equal to the interest rate on the debt, 9%, times 1 minus their tax rate, 30%. 6.3%. In other words, 9% times 70%, 1 minus 30% is 6.3. So they're really paying, yes, they have to write checks for 9% of the interest, but they get a 30% tax deduction on their interest. Thus, their after-tax cost of debt is 6.3%. So if I put that down here, 6.3%, notice my weighted after-tax cost of debt is taking the weight or the percentage of the capital structure and debt of 60% times the after-tax cost of debt of 6.3, and you get a weighted cost of 3.78% in relationship to the percentage of the company in debt. Now we have to determine what is it costing us for this 40% cost of equity. And that is using what is called the capital asset pricing model. And this is also discussed in our textbook under risk and return. The capital asset pricing model is a model to determine what investors expect as a return on their investment in the current market for equity. All right. So here's what that means. If I wanted to get no risk at all, I would get a 10-year United States Treasury yield. No risk at all, I would get a return of 3.1%. If I wanted to invest in the stock market today, I would get a return of 10%. That's the market average. But how much would I get as a return if I invest in this company with a beta of 1.35? Well, it's probably going to be greater than 10% because its beta is higher than the market average. And that's what the capital asset pricing model. It takes the risk-free interest rate, 3.1, plus what is called the market premium rate. And the market premium rate is the market rate of return minus the risk-free rate. That's called the market premium. And it multiplies that times the firm's beta, 1.35. So 3.1% plus 10% minus 3.1 times 1.35. and you do that arithmetic, and you get what is the investor expected return for this company with a risk of 1.35 in the current market. And that's what that all represents. So if we go ahead and do this calculation, and let's go ahead and do it, equals 0.031, that's the risk-free rate, plus percentage, because we're doing some calculations here, plus 10%, which is our market rate of return, minus 0.031. And then we're multiplying that times 1.35, the risk of the company. So 3.1 plus 6.9% times 1.35, what do we get? 12.42%. In other words, in today's market, with a company with a beta or risk higher than the market average, investors will be willing to buy this company's stock if they can get in the prospectus and the business model of this company a 12.42% return on their investment. That's their cost of equity. So if I put that 12.42% down here and weight it by 40%, I get 4.97%. So right now we have done an analysis of this company's capital investment position by taking their capital structure and determining their cost of debt after taxes and their cost of equity based on the market risk and the market returns. And we get a weighted average cost of capital of 8.75%. That's this number in chapter 8 of 12%. That's this number in the problem we just did in chapter 9 of 11%. For this company in today's market, it's 8.75%. That is called the weighted average cost of capital. It's also just called the cost of capital. It's called the discount rate. It's called the hurdle rate. All those mean the same thing. This is what it's costing them to get their money today. This calculation is done every month, every quarter, every year for every corporation in America. So now we go to this base analysis here and we put in our WACC that we just calculated of 8.75%. That is now a variable in this case. So now we can begin to do this analysis. Just like we've done before in chapter 8 and 9, now we have this set of variables right out in front of us. And our job is to put this into some semblance of order. We're told in this problem that the depreciable life is 10 years. Our investment is $1 million. $1 million. All right. What's our revenue going to be? Well, they tell us that we're going to sell 25,000 units every year for 10 years. And we're going to sell them at a price of $20 a piece. That's $500,000 in year one. But then look at this variable here. The average sales price is going to change after year one, 2.5%. That's inflation. So now we have to account for the inflation in our revenue. So all I have to do is hit equal year one sales, 500,000, and I'm going to multiply that times 1.025. Why 1.025? It takes the 1 and adds 2.5% to it. And I get $512,500 in year two. And now I'll just copy that formula all the way out to year 10. And there we go. There's my total sales inflated at 2.5% a year, 25,000 units sold every year at a base sales price of $20 a unit, increasing by 2.5% every year to inflation. All right. And what's that total? Well, let's do a total here. We'll sum that. That's $5 million, a little bit over $5.6 million of total sales. There's our revenue line we just calculated for our cash flow. What are our expenses? Well, in this analysis, expenses are not a percent of sales like they were in chapter 9. They're variable and fixed costs. Variable cost is costs that per unit stay the same. The more units you produce, the more expenses, but variable costs are a per unit cost of wages, production, whatever. Variable cost. Some of you might have taken this in accounting, managerial accounting. Well, look at our variable costs here, $8 per unit. So in the first year, we're going to sell and produce 25,000 units, and we're going to multiply that times $8 variable cost. All right, there's our $200,000 of variable cost in year 1. Then notice the inflation rate for variable cost. It's different than the revenue inflation rate. It's 2%. Why? Well, different aspects of inflation. You get a lot of your costs in another country, from overseas or whatever. Different cost restrictions. The inflation rate is different, 2%. So now we just take year 1 like we did in sales and multiply that times 1.02, 2%. And that now we're inflating our variable cost 2% every year. We'll take all that down to year 10. We'll copy down the formula for summing. And there's our total expenses, a little bit under $2.2 million of variable costs off this project. What are our fixed costs? Remember, fixed costs are costs that are not tied to units produced, but just a regular fixed cost of operations like insurance, maybe salaries, maybe rent, fixed costs. And we're told in this problem that our fixed costs are $50,000 every year. But also fixed costs, like any other cost, inflates. And in this particular problem, it inflates at 1% a year. So just like we've been doing, we take the year 1 times 1.01. That's the inflation rate. And now we have the inflated fixed cost in year 2. Take that all the way to year 10. And there's our total fixed costs for operating this project. Copy that sum total down, and there's our total fixed cost. Our depreciation. Well, they give us this depreciation in this problem. We're depreciating the 10-year, $1 million investment, straight line, $100,000 a year. So $100,000 is our depreciation amount. Naturally, there's no inflation here. It's just straight 100,000. There's that. Sum it up, should be $1 million. And there we go. And now we have all the components to begin to determine our net income. Earnings before taxes equals sales minus variable costs minus fixed costs minus depreciation. And there's our earning before taxes. In year 1, we'll just copy that all the way down, total up that sum line. And there's earnings per taxes about $1.9 million. Now we take our taxes equals earnings before taxes times our tax rate of 0.30, 30%. And there's our taxes we pay every year based on our operating profits. There's the total taxes, 30% of earnings before taxes. Let's bring up that sum line again just to look cool. And we have $500,000. So thus our net income is our earnings before taxes minus our taxes. And there's our net income. Follow that all the way along. Whoops. There we go. And here's our total profits, net income. That's not our total cash flow. That's our total accounting income of a $1 million investment generating $1.32 million in net income. But that's not our cash flow, as we've seen prior examples. Our cash flow is made up of some other items coming in and out during the life of this asset. First of all, something new that we haven't seen yet, salvage value. We're told in this problem that at the end of 10 years, this asset of $1 million will have a salvage value of $50,000. In other words, we can sell it, scrap it, and get $50,000. But there's a problem, not very difficult problem. We fully depreciated this asset over its life. So at the end of its life on our books, it has an investment of $1 million and an accumulated depreciation of $1 million. That means it will have an asset value of 0. Thus, the $50,000 is considered a gain on that disposal. So that's taxable income. So now we have to change this $50,000 to take and account for our tax. So $50,000 times 1 minus our tax rate, which is 0.3, will give us our our after-tax income on the disposal of $35,000 of additional cash flow coming into this project by the disposal of the asset at the end of 10 years. Now remember, this is an analysis today for 10 years down the road. We might not scrap it at the end of 10 years. We're just calculating what we're estimating the life of the asset to be and how much we're going to gain out of that investment. So this doesn't not necessarily mean we're going to scrap it at the end of 10 years, but since it's fully depreciated, that's why we do this. So now we also add back in, like we did in chapter 9, the $100,000 depreciation. Remember, that's non-cash. So we add that back in as cash flow. Let's copy these down here. And there's those numbers there. And now we have to determine, remember, working capital, net operating working capital, they call it here. And notice, just like we did in chapter 9, net working capital is 12%. In this problem, 12% of the next year's sales. So in year 0, we have to take 500,000 times negative times, there we go. Let's start over again. Equals 500,000, that's our next year's sales, times minus 0.12. Why minus? Because this is going to be negative cash flow. And here we go. So additional $60,000 is going to be needed in this project in year 0 to give additional cash to get this asset in working capital up to operations. 12% of the next year's sales. Now remember, in chapter 9, where we had declining revenue, after year 1, working capital was a positive number because revenue was declining. But notice here in this example, in this case, revenue is increasing every year. So our working capital base is going to have to increase every year at 12%. How do we determine that? We put in a formula, equals year 2 sales minus year 1 sales. And let's do that again. Let's put that in parentheses and isolate that formula. Year 2 sales minus year 1 sales, and then multiply that times negative 0.12. And we get $1,500. Here's what this means. At the end of year 1, we've accumulated $61,500 of working capital cash being expended. What's 12% of $512,500? Well, let's do that. Equals this times 0.12, 61,005. So at the end of year 1, we have 12% of accumulated next year's sales of $512,500. So this will happen every year up to year 9. Notice revenue is increasing every year. So we're just going to copy this cell all the way to year 9 and see that we have additional cash flow needs of 12%. So let's just total this up. At the end of year 9, we've accumulated $74,932. Let's check that out. If I take 609,201 times 0.12, it should be, and there it is. Hang on here. I'm a little off. Why did I go off? Oh, I'm sorry. I did not include year 10, dummy. So if I take year 10 times 0.12 and 74,932, that's exactly what this is totaling. Then in the 10th year, where there's no year 11, I add back in 12% of that sales number, 74,932. So that's cash coming back in. So remember when I said in chapter 9, the total line of your working capital should foot or total to zero. And if I take that all the way across, zero. I've wiped out all the accumulated working capital because the project is now over in year 10, and I'm adding back all those working capital cash flows as positive in the 10th year. So now we can calculate our net cash flow. In year 0, it's simply 1 million plus the 60,000. In year 1, it's net income plus, there's no salvage value, but we still want to include that in this calculation, plus the depreciation, plus, in this case, the negative working capital, and there's our cash flow. And we just slide that all the way across. And notice in year 10, we have quite a bit amount of cash flow because we're adding in the salvage value and the recoup of the working capital. So let's total all that out. We're generating $2.417 million of project cash flow off this investment of $1,060,000. Looks pretty good. This is what you're going to be doing in assignment 3, is calculating these cash flows and putting them together. Now we can take it from here, knowing that what's our discounted cash flow? Formula, function, NPV. What's our cost of capital? Well, we calculated it as 8.75%. Remember we did that? And now you take the values of year 1 through year 10, F21 to O21, and we get our total discounted cash flow. Our net present value is the difference between that discounted cash flow and the investment of $1,060,000. Woo, 456,608, a very profitable investment return. What's our internal rate of return? Formulas, function, IRR. What's our values from year 0 to year 10? 17.03%. Not bad. Now remember, I have preset this formula here to go to the 2 decimal points. If you just calculate this problem out and got this number without the decimal points, that's not incorrect. Remember, your percentages need to go to 2 decimal points. That's the correct answer. Our profitability index is the relationship of the discounted cash flow divided by the investment. It's definitely going to be over 1.43. And our project payback. Well, we're investing $1,060,000. We're generating a return in year 1 of 203.5. That's what we have left to recoup in year 2. The year 1 balance plus the year 2 cash flow. There we are there. And let's take this out about 3 more years. And as you can see, in the 5th year, we begin to we get our money back. 1, 2, 3, excuse me, in the 5th year. 1, 2, 3, 4. How much of the 5th year we're going to need? We just take our year 1 balance and divide it by year 2 investment return. 0.94. 1, 2, 3, 4.94 years. We recoup that in a little bit under half the time. We are done. Let's save that. So here we've put together the capital budgeting process, except for step 6, which you don't have to worry about. We've determined the cost of capital by taking the relationship of the capital structure to the cost of debt and the expected return of equity, the capital asset pricing model. We get 8.75%. That's our discount rate. We apply that 8.75% to the cash flow that we just calculated based on all the variables given in this problem. And we've completed the analysis. And in return, we must say this is not a dog with fleas. This project, or this investment, I guess you could say, is a go. They're making their money. They're producing a return in net present value of almost $457,000, a return of 17.03% compared to a cost of 8.75, a profitability index way over 1, and a payback in half the time. This looks like a good project. And now we've just completed chapters 8 through 12 of our textbook in this one problem. That's what assignment 3 is all about. And let's take a look at assignment 3 now that you have these templates. Let's take a look at what assignment 3 is all about. Okay, here's assignment 3 that you have to do for Sunday. Good thing about this is we've gone through this in the last 2 videos. The good thing about it is I give you a spreadsheet to fill out. You don't have to create the spreadsheet. I've created the spreadsheet. All you have to do is figure out the numbers and do the arithmetic. And we'll take a look at that in just a minute. So here's the problem. You're asked to do a capital budget analysis, and I give you the cost of capital. You do not have to calculate it in this problem. The cost of capital is 9%. Now here are your variables. An investment of $750,000 over 5 years with a depreciation of $150,000 a year and a salvage value in year 5 of $25,000. A working capital base of annual sales of 10%, a tax rate of 22%, an inflation rate for selling, variable cost, and fixed costs. The inflation is the same for all those 3 variables, 4%. You're going to sell 40,000 units a year at $40 a pop in year 1. Your fixed costs are $175,000 in year 1, and your variable costs per unit are $30 a unit in year 1. I want you to tell me what is the net present value, the internal rate of return, the profitability index, and a payback. Do that analysis, and your only answer is, after you've done that, will you determine that this project is a go or no go? Type those words into your spreadsheet. Go, yes, it's positive or good, or no go. This is a dog with fleas. All right. That's your assignment, is to complete this analysis. And you complete this analysis on the spreadsheet that I've provided in assignment 3. And here's this spreadsheet. And you can use the practice spreadsheet that we did tonight as an example. I have given you here all the variables for assignment 3. I've already listed them here. You don't even have to worry about that. Here's all the variables. Here's the room where you put your numbers. You have to do the arithmetic, total them up. Do the tax rate, total them up. Add back in salvage after taxes and such on, just like we did, and come up with this line. Once you come up with this line, knowing your cost of capital, you can determine the discounted cash flow, the NPV, the IRR, the profitability index, and what the payback in years is. And then you say, this is a go, or this is a no-go. Those are the words I want to see after you do this analysis. Do you think this project is good or bad? Go or no go? So you have to download this spreadsheet and fill it out. That's your job. Now, if you want to create your own spreadsheet, fine, but you're adding yourself some more work when it's already ready for you. You just got to type in the information, do the arithmetic, and you're off to the races. And you can use the spreadsheet that we just did in tonight's lecture video and look at the examples from chapter 8 and 9 as your template to know how to do all this. So you're off to the races for assignment 3. All I want to see when you post this to Blackboard by next Sunday night is this spreadsheet. No PDF of the spreadsheet, you'll get a 0. No Word format of this spreadsheet, you'll get a 0. The spreadsheet so I can see your calculations of inflation, and so on. If I can't see those calculations, you get the problem wrong. But if you put in all your information and your arithmetic and you come up with your numbers, you'll get it 100%. So that's your task here in assignment 3. You'll have a similar problem like this on your final examination in a few weeks, where the only difference is you'll have to calculate the cost of capital. This is good practice for that final examination. All right. I'll be available for questioning throughout the week. Remember, we have student hours Thursday night, 6 to 8. You can ask me questions about this. I'll be available for any questions or concerns you have, but now you have all you need to know to complete a capital budget analysis like any financial manager does in any corporate finance department around the world. Thanks, everybody. Have a great week, and we'll see you either Thursday and in my weekend video, which will be posted Friday or Saturday at the end of this week, as further follow-up to this work. Have a great week, everybody. Adios.